For disclosure purposes, our site does not make recommendations for purchases or sale of stocks, services, or products. Nothing on our site or this podcast should be construed as an offer or solicitation to buy or sell products or securities. All investing involves risk and possible losses. This podcast is for entertainment purposes only. Please read all disclosures and disclaimers at the end of the show. Thanks for joining us again on the Exploring Mining podcast. Today, my guest is Garrett Goggin, CFA and founder of the Golden Portfolio, and today we talk about what's going on in gold, U.S. policies, royalties as a play, and explorers versus developers. Garrett has over 15 years experience as a precious metals analyst. To learn more about Garrett, you can sign up for Garrett's free Secrets of a Mining Analyst Masterclass on the link below. Garrett, it's so great to have you on the show. For listeners that are new to your story, do you want to just give a quick background on how you got into the markets and into gold?
I'm from Boston, the institutional community. I work for Putnam Mutual Funds where you invest for the long term and everything's going to be okay. But, what if everything isn't okay in the long run, like Keynesian's long run, like we're here right now. I'm a CFA, Chartered Financial Analyst. I'm an MBA from Babson College. And I've been working with John Duty, the gold stock analyst, and Stansberry Research for the past 15 years. And then I just went out on my own and started the Golden Portfolio last year. And I look at the Golden Portfolio as your ultimate gold investment.
I feel like the first thing we probably have to talk about is the tariffs. I feel like Canada it's our first breakup here, so we're not handling it well. But I do feel it's long term, it's fantastic for both countries. I mean, already BC has fast-tracked 18 mining projects since the announcement of the tariffs, which is great for the mining sector. Do you want to give some of your commentary on what you think is happening probably short-term, long-term with this?
Yeah, sure. Well, gold's been going crazy, right? So, and a lot of people are attributing that to tariffs, but there's more to play with that. Most of it, China's been buying gold. China is our major trade partner. China used to reinvest their excess trade surplus into U.S. dollars and U.S. treasuries. They're not doing that anymore. Their percentage of U.S. debt outstanding has declined from like 30% down to about, I think, around 15% over the past 10 years. China's buying gold hand over fist. That's why, gold has been going higher. And then there's other stuff behind the surface. So, it's deeper, than the tariffs. And then you get Treasury Secretary Scott Bessent and Trump working together. Both of them need a lower U.S. dollar in order to, get the U.S. economy going. But they want to reserve the dollars world reserve currency status. The way they do that is through gold. And it just came out this morning. There was an article in maybe the Financial Times, written by a very reputable writer, talking about what Scott Bessent said yesterday. He said, we are going to monetize the asset side of the U.S. balance sheet. Well, what's on the asset side of the U.S. balance sheet but gold that's being valued at $40 an ounce? They can revalue that to $2,800 an ounce. That would create $800 billion, which is a drop in the bucket for the 37 trillion debt outstanding. But the gold is coming back as a monetary metal. The reason why London gold is trading at a discount, it appears, the U.S. market is trading at a premium, but it's actually London trading at a discount, and all the gold is flowing from London to the United States. The reason why that's happening is because London's out of gold. London, people are withdrawing their gold from the LBMA. Now the waiting time is a month or 2 months. People can't get their gold. So are you going to buy your gold from an exchange that can't deliver the gold, or are you going to buy your exchange from a place where you're going to be delivered the gold? And that's why the gold is leaving London and it's going back to the United States. And there's like 4 or 5 other reasons why gold is coming back as a monetary asset. Like I said, Trump needs lower rates. The 10-year rate has declined a little bit, but the best way to get the rates down is through yield curve control. Yield curve control is a form of QE. This would be QE5, where the Federal Reserve is enabled to buy treasury debt. This is straight out money printing. It'll represent dollar devaluation. That's definitely not out of the question. The whole yield curve control. The other thing, the United States announced that they are going to start a sovereign wealth fund. Well, guess what the sovereign wealth fund is going to hold? It's going to hold gold, lots of gold. Trump's been a fan of Judy Shelton. He tried to nominate her to the Federal Reserve last time he was president. Judy Shelton's a big gold bug. Judy Shelton proposes a 50-year treasury bond to be backed by gold, to be issued on July 4th, 2026, the 300th or 400th anniversary of the United States. Then also Bitcoin, right? Everyone loves to compare Bitcoin to gold. I see Bitcoin as the gateway drug to gold. The reason why people own gold in Bitcoin is because of dollar devaluation and money printing. Bitcoin has a limited number of 21.3 million outstanding. Gold does as well. There's talk of the U.S. establishing a U.S. Bitcoin reserve, probably in that sovereign wealth fund. Well, you know where they're going to get the money to buy that Bitcoin? They're going to revalue gold on their balance sheet, bringing it back into the monetary system, as an asset. And then lastly, our trade partners, like China and the UAE, and Russia, the Enbridge, they're starting their own currency. That's potentially going to be backed by gold too. Like, we're in crazy times here. Gold's coming back as a monetary asset.
Do you think we're going back to the gold standard, basically?
I don't know. One of the other things, I don't think we're going to go back to a strict gold standard where your trade surpluses are paid off in terms of gold. But, the currency system needs a standard of measure. You can't measure, Canadian dollars and US dollars, because US dollars isn't a standard of measure. The amount keeps going up. It's like measuring height in pounds. Both things change. It's just absolute nonsense. So you need some sort of standard. But one thing I do see is that, countries like, especially Europe holds about 4% of their GDP in gold reserves. China only holds about 1%. US holds 2%. China's been adding tons and tons of gold to get this number up to match 4% of GDP. So I potentially see them backing GDP by gold, 4% of GDP by gold. Now, this makes sense because it allows them to target economic growth. But it allows them to continue the money printing, right? So it's not the money that's tied to it, it's economic growth and GDP. So that allows the big spend to continue, the debt to increase, but everything will be okay as long as we hold 4% of GDP to gold. But, that won't end long because the money printing is going to continue.
I think a lot of analysts had talked about that we were going to take a while to get to $3,000 prices for gold, and now it's kind of looking like it's not going to take that long. What's your forecast for this year? I mean, I think we're pretty close to 2,900 today.
Yeah. Like 2862, made very close to 2900. It's down a little bit. But I don't like to make price forecasts because it's merely conjecture. It's like, oh, 5,000 gold, 10,000 gold, whatever, 20, who knows? You can look at the number that you'd have to revalue gold to pay for the $37 trillion debt, and the number is over 100, it's like $130,000. But what I will say is that I measure sentiment really closely, as an investor, as a, analyst. And the S&P, a popular S&P 500 ETF in the United States, the GLD had as many assets in it in the last peak in 2011 as the SPY did. And right now it's 10%. There's 10 times more assets in the S&P than gold. I look at shares outstanding for the GLD. I look at shares outstanding for the GDX. It's minimal. Even with the big up move in gold, there's no investors coming back into gold right now, which shows me like when everyone rushes in, that's going to be the next peak. We're nowhere near that.
So how do you play gold as far as with the golden portfolio with you? What are some of the key trends that you follow or you believe in are the best ways to play, especially as investors are starting to look at gold again?
Yeah, so I've three products. One of them is the Golden Portfolio, the GP. That focuses on, I call them inflation protection machines. It's the royalties. The royalties are the best way to play gold. Why? Because they have fixed costs. So no matter when inflation pushes gold higher, mining costs increase. So the miners' margins are no higher than they were 10 years ago, even though gold went up 3x because costs have escalated. Whereas the royalties, they lock in contracts, and the contracts never change over the life of mine. So it might be 10 years or 20 years, they're still locked in at the same price. If it's a stream, which is like 20% of the gold price, their costs don't escalate as the gold price goes up. So the margins continuously increase. The royalties, if you look at a chart of the royalties, basically the majority of them, all the big ones, Franco, Wheaton, Royal, and you compare them to the price of the gold, they outperform the price of gold. And why do they outperform the price of gold? Because they can grow earnings on a per share basis. That's something that the miners have trouble doing. And then the royalties, they are run by 3, 4, 5, 6 people. You get a geo, you get a guy to count the money, you get a lawyer. There's no overhead, whereas the miners have hundreds of people. The royalties get free exploration upside. They pay for the life of mine asset. And when they find more ounces, they get all that for free. And we're talking, life of mine, we're talking 10, 15, 20 years down the road. And they have contracts like Pierre Lassonde paid $2 million for the Home Strike royalty, found it in the Elko Gazette, went down there and bought it for $2 million. That's delivered $500 million to Franco already, and it's potentially going to deliver another 500 mil. They spent 2 mil for $1 billion. Origin Royalties spent $100,000 acquiring Silicon Merlin. Silicon Merlin, owned by AngloGold, is going to be one of the biggest gold mines in the world. They did exploration drilling looking for water. They found more gold. This thing holds 13 million ounces. It's going to produce 1.6 million ounces in the first year of production, making it one of the largest gold mines in the world. Origin owns a 1% NSR. Basically, they turned $100,000 into 100,000 ounces of gold worth, what, $250 million? Like, the leverage you get in the royalties is tremendous, and they offer better protection on the downside. My other product, GP10X, focused on explorers and developers and the trough of the Lassonde curve. Do you know the Lassonde curve that everyone talks about?
Yes.
Yeah, so the exploration starts, you get a couple good hits, it rises up, and then they got to go through financing. It's usually dilutive, trends back down, and once it's fully financed and fully permitted, it trends back up to peak right at first production. Now, one of the things that's interesting as an analyst is miners' equities are worth the most on day one of production. Why is that? Because they haven't started producing yet. As each year goes by, their production, they generate production, but their reserves go down, unless they have exploration success, which they do, but it only replaces the ounces that they have. So the reserves decrease, the life of mine decreases, the equity value decreases. So miners are worth the most on day one of production. So that's why I focus on the explorers and developers. I have some developers in my portfolio like Rio 2. Alex Black, he built Rio Alto. Rio Alto was taken over by Tahoe for Shahuindo and Lorena. Then it was acquired by Pan American. And it's a run-of-the-mill heap leach, which means they don't need any processing. They just take a shovel of dirt, they throw it on the heap leach pad. Process is extremely low cost. It's in Chile, it's Phoenix. They just began construction. It's only going to take them a year. They're going to be in production in 2026. The stock is trading at 300 million market cap. Phoenix is worth $1 billion. So on first production in 2026, EV should rise to get near the total NAV value of the asset. So 300 mil to $1 billion. You get Montage Gold. Again, same story. I think it's trading for about 300 mil. Their Kone deposit's worth $1 billion, and Wheaton Precious just financed them with a stream. It was great for shareholders, retained all the majority of the equity value. And on first production in 2027, EV should match NAV. And it's like nowhere even close. Like, not only is money not flowing into the GLD right now, it is nowhere even close to these gems that I see in the sector. And when the peak happens, and the money starts flowing in, there'll be a point where we'll be like, wait a minute, like, this asset's only worth $1 billion. This stock is trading at $2 billion. Like, watch out. And at that point, be more cautious. But right now, you're basically spending dimes for dollars.
Do you think we're still going to see the same narrative coming into this year that basically just the discovery stories have the run in the market, or do you think that's going to change? Because I feel like the last couple of years it's been pretty quiet out there as far as the juniors and explorers, besides a good discovery story.
The explorer space is really picking up. Orosur Mining, they have a project. I've been following that. They have some crazy good drill results. It's London listed, so I don't necessarily cover it too closely. That stock's up, I don't know, 200, 300% over the past like 3 months. And, people like to invest in all these crypto tokens that are absolutely backed by nothing, and they go up 10x, in a day, and then go down 9x the next day. But at least these gold exploration companies are backed by something. They're backed by ounces in the ground. And, I see the speculative money in Bitcoin that's going to be flowing back into the gold sector, and it's going to be pushing these explorers like through the roof. There's basically no money in it right now. Regarding developers versus explorers, I don't know. I've seen some action in the explorers. I haven't seen that much action in the developers due to the undervaluation that still persists, like Rio Alto and Montage. Just, there's some smart money in the sector, but it's only a handful of Canadian institutional funds. U.S. institutional funds are nowhere near the gold market right now.
As Trump is pushing so much for the drill baby drill, that we're going to see more of the U.S. funds come into gold and mining as we progress this narrative.
Yeah, I tell you what's gonna tip the balance is these institutional investors, they track performance. When they start lagging, their benchmarks, they are gonna have to allocate to the sectors that have been doing well. And that's been gold, over the past whatever couple months. And as it persists, institutional investors are going to be forced back into investing in precious metal equities because they're nowhere near here right now. I think the S&P held like 20 years ago, it was 20% of the S&P was mining, and now it's 1% of the S&P. So it just shows you how far away from a potential peak we are.
Can you talk a little bit more about your products that you mentioned, your royalties product and then your juniors and explorers? How many companies do you cover? What's your criteria?
The royalties, it consists of 13. You have the larger cap ones, but you also have the smaller caps. Most of the performance attribution comes from the smaller cap names. There's 5 or 6 of them because in the royalty industry, there is always an ongoing flow of consolidation. Every smaller royalty that has a good asset gets snapped up. I've seen 10 of them over the past like 10 years. You get Maverick, you get Nomad, you get Great Bear, I could go on. And there's a couple smaller royalties that have amazing NSRs and royalties and streams on some amazing assets. They're going to get snapped up, and that's where a lot of the performance comes from. The major outside. I look back. I'm like, God damn, what if you just made a portfolio of royalties? And I look back when Franco got rolled out in 2007, you'd be up 15 or 16,000% for that time. Like seriously. And you look at the gold miners, the GDX is the same price it was, whatever, 10, 20 years ago. It's just the royalties are the best way to play it. But it's a little boring because, it's just consistent outperformance. But it doesn't really blow your mind until you start getting the acquisitions in the sector. And I say it's like watching paint dry, but it's 24 karat gold paint.
I love that. And for your other portfolio that you have,
Yeah, it's 30 companies on my GP10X. Some of the really world-class assets, cream of the crop of the explorers and developers. And there's 30 of them, right? Because you're going to be wrong a few times. A few of them are going to go down 50% or more. But you see the winners in your portfolio. Once you have 2 or 3 or 4 winners in your portfolio, that makes up more than your percentage losses. So they say like 95% of portfolio gains come from your winners, and it's the same strategy with the GP10X. You need to be more diversified. You really can't get overly weighted towards one company because then you make stupid emotional decisions when the stock goes up too much or down too much. We hold on to our winners because the winners have intrinsic things going on, which produces their up performance. Like, look at the winners over the past 20 years in the general stock market, right? It's like, all right, I use Amazon. I like Amazon. You should have just held Amazon. Google, I like use Google every day. You should have just held Google. Same thing with these well-performing explorers and developers. They have intrinsic things going on. So over time, it grows to be a larger portion of your portfolio. And a lot of these smaller, attractive companies with solid grades, they're going to be acquired. And then my third product's the GPIV. That's my introductory product. It contains 5 of my favorite companies, and last year was up 140%. And this year, I don't know, another 15, 20%. So
That's impressive that 140% in a year like last year. So congratulations on that. We haven't talked about silver yet. Do you cover anything on the silver side? And
I have 6 silver companies. I have a couple of explorers. There's a couple of high grade exploration stories that are very interesting right now. And the deal with silver and gold is it's all about grade, right? It costs $250 per ton to mine silver underground in Mexico. So, that means silver's trading at about 31, right? So you get 31 grams per ton. It's a 1:1 ratio. So you need 250 a 250 gram per ton of rock to basically break even. Now, if you look at the grade of a lot of these smaller silver companies that operate in Mexico, they're unprofitable. They're operating at 200 or 150 or even close to 100. They're never going to make any money. And what happens is in order to plug the hole in their balance sheet, they continuously issue shares, resulting in dilution. So they go down like 98% of the time, except for that 2% of the time or 1% of the time that we're having now, where silver really starts ripping and gold starts ripping, where they'll spike up due to a short squeeze, but then they end up coming back down. I'm more focused on companies that can grow economics on a per share basis, high grade silver producers, that generate profits. If you don't have profits, you can't generate shareholder value. You use profits to issue dividends, buy back shares, increase earnings on a per share basis. And, I've been all over one for a long time, Mag Silver, Juanicipio, right? Peter McGaw, geologist, found it in his first drill hole. It's like 600 grams a ton. That's producing profits right now every single quarter, whether silver is at $20 an ounce, $30 an ounce. And then Silvercrest Mining has been a favorite. That's like 750 grams a ton. Las Chispas and Core Mining just swooped in and snatched them up because it's an extremely profitable, accretive operation. But so basically, I invest for the 99%, not the 1%. There's a lot of misinformation out there on the internet and Twitter where people are promoting all these low grade moose pasture portfolios, that when silver rips, they're going to go up 10x and blah, blah, blah. And I track these portfolios. They go down every year. You might have one year where it'll go up 100, 200, 300%, but the other 99 years, it's losing 30% of its value due to dilution. So, I prefer, the accretive ones that put money in the bank that, don't have to dilute.
for investors out there, like what is your criteria when you're looking at a company? Is it share structure? Is it the management team? Is like, are there 3 things that are like criteria number 1, 2, 3 that they have to have for you to even take a look at?
The quantitative metrics, those are easy. You look at the financial statement, you get the balance sheet, but then you get your soft metrics that are harder to quantify. Management is obviously very extremely important. I stick to the value generators, the industry, the guys that have done it before. One smaller explorer, gold explorer in Guinea and Africa, just released amazing drill results. They're partnered with Lundin Group. The Lundins have been moneymakers in the gold industry for decades. They spun out Lundin Gold that owns Fruta del Norte. I stick with guys like this, and then you get other guys that just destroy value. Year in, year out, they roll their shares back. They come out with a new name trying to hide it. But, I've been in the industry long enough, been to all the conferences. I know who the good guys and I, know who the bad guys are. And then, I'm lucky enough to have a Bloomberg, and, Bloomberg, you can look at price charts, but one of the things, instead of price, you can type in shares outstanding. Some of these shares outstanding are horrifying. And that's, another thing that I look at very quickly. And, my secret skill, my superpower would be I can look at a company and in 15 seconds, I can find out whether it's worth spending more time on or not. And shares outstanding is one of the things that I look at. And it's hard to find out there. Like it's not on Yahoo, like it'll show current shares outstanding, but not historical. It's not on Google or anywhere that I found publicly. But through Bloomberg, I have it. And if I see shares outstanding going from 100 to 200 to 300 to 400 over 3 years with no value generated, like no, thank you. I'm out. I'm not even close. When people think of silver, a lot of people think of Core Mining. It's a big silver company, great. Core Mining split adjusted was $200 per share back in the late 90s. Right now it's trading at, I don't know, 5 or 6. It's down like 97, 98%. Why? Because their shares outstanding have gone from 30 mil to like 300 mil or 3 billion shares, and they had a couple of rollbacks. It's just ridiculous. Companies like that, they exist. The management get rich and the bankers, get wealthy and shareholders get screwed. And, I'm able to identify companies like that and avoid them because they don't care about shareholders and they don't care about the share price. All they care about is getting paid.
I feel like when I met you at Metals Forum and during Roundup and VRIC, the number one conversation that I heard from every investor was the market cap, share structure, and that's the number one thing I feel like everyone's paying attention to because yes, we've had some unfortunate share structures in junior mining. So it's great to hear that that's on the forefront in your newsletter.
One more thing about share structure. It's the nature of the beast. It's the way mining's done. You know what I mean? You can't change it. It's the specific characteristics of mining. You need to raise money for exploration. Exploration is, like throwing darts at a board. Some are successful, some aren't. And then, even when you're in production, the value of a mine is the most at day one. And it goes down over time. That's why the majors have trouble driving earnings on a per share basis. Yeah, and one other thing right now, the majors, there's no money in the majors. If you know how you discount money, a NAV analysis, right? You discount it at 5% every year. So you get $1. Do you know what it's worth at the end of 10 years when it's discounted at 5%? It's worth 7.7. That is terminal value NAV. And right now, the majors of the gold industry are trading at 6.2 now. This is below terminal value. You're buying free cash flow at a discount here. Just shows no one is invested in this sector. It's an extreme opportunity right here. I'm eagerly waiting fourth quarter numbers from the big guys to see where the production and the all-in sustaining cost fits in. But with the juniors and explorers, you're buying dimes for dollars. With the majors, like we're setting up for a really good run here in the GDX.
Do you want to talk a little bit about how that works if someone's interested in signing up and the different price points and how they can try things out? Or
if you want to learn more about my portfolio, follow me on Twitter, Garrett Goggin. Go to my website, Golden Portfolio. I have a free Secrets of a Mining Analyst masterclass where I talk about a lot of this. And, I set Golden Portfolio up to bring you the truth, and that's what I hope to do every day with my stock picks and with my research at Golden Portfolio.
For any investors that want to come see you at any of the conferences, I know you were just at Metals Forum, and I think I saw that you're going to be at Money and Mines in Miami as
Yep.
well. Anything else on the agenda?
Not right. I got 3 little kids at home, right? 9, 7, and 7. Last trip I went on, I missed 2 hockey tournaments, a few baseball games. Yeah, the kids were dressed up in their baseball uniforms for their hockey games and their hockey uniforms. So yeah, I gotta tie down the house here. But yeah, I'm going to PDAC, I'm going to Mines and Money, go to Beaver Creek every year, and then I also love going over to Switzerland for the Denver Gold Conference or the SMI.
And I always like to close with a story. What is your favorite gold story that you've experienced or heard of? Or
I've had a few, big winners in the past, and, they all share the same characteristics. It starts in the balance sheet, it starts with the people and the profit and loss. And I look at it and I'm like, measure the profits, and I'm like, wait a minute, this company's trading at like a 20% free cash flow yield. Like it's extremely undervalued. That got me on Silvercrest Mining back in 2015, right before it got acquired by First Majestic Silver and then spun out Silvercrest Metals that was just acquired by core mining. And that's what gets me on board. And then another one, New Market Gold. New Market Gold had a couple sleepy Australian assets at Stalwell, Cosmo, and Fosterville. And then, it's trading at a 20% free cash flow yield. And what happens? It's like a margin of safety, right? Like if you're generating significant profits, you get paid to wait because there's not going to be any dilution. And then they're going to be able to use the money to hopefully do smart things if they're good managers. And then all of a sudden, Fosterville started delivering these crazy drill hits, like at the Swan Zone that were 100 grams per ton. And then Newmarket got bought out by Kirkland, and Kirkland got bought out by Nico. And if you held on to your shares the whole way, you'd be up, I don't know, like 45,000%. That's why I say, hold your winners. If it's doing well, just maintain your exposure to it. But that's why I started the Golden Portfolio, because the things that attracted to me were, management, high grades, profitability, strong free cash flow. And, that's why I started the Golden Portfolio. And I've got a whole portfolio of these guys right now. The next New Markets, the next Silvercrest. And New Market, after it got bought out, these guys, they're smart private equity guys. They're trying to invest, 100 mil and get 300 mil back or $1 billion back. They care about whether they get return on their money. It's a lot of miners, the major miners don't care. They're replacing production with more production. They don't care what they pay for it. That results in declining earnings per share. That results in a declining stock price. I look for the guys that actually are looking to turn, $1 into 10, that are looking for a return on their assets, and then these guys, the smart private equity guys, they went in and they bought a couple assets, Libertad and El Limon from B2 in Nicaragua, and they started Caliber. And then Caliber just purchased the Valentine project up in Newfoundland that's going to be in production very soon. And it's the same story. It's the same guys. And again, they're generating cash. They're putting in the bank. They're generating shareholder value. I'm getting paid to wait. The share price goes up and everyone's happy.
I feel like if you know what the next Silvercrest is, I want to sign up. So.
Well, that does it for today's Exploring Mining podcast. If you'd like to be a guest or sponsor for this podcast, please contact InvestorIdeas.com. InvestorIdeas.com reminds all listeners to read our disclaimers and disclosures on the InvestorIdeas.com website. All investment involves risk, and this podcast is not meant to be an endorsement to buy or sell securities or products. To hear more podcasts, you can go to InvestorIdeas.com/audio. And a reminder, you can also hear our podcasts on iTunes, Spotify, Google Play Music, iHeart.com, TuneIn, Stitcher, Spreaker, and SoundCloud.